Hello and welcome. For today's interaction, I'm joined by my colleague Chirag, and we have with us Devang Shah, Head of Fixed Income at Axis Mutual Fund. Welcome, Devang.
Thank you. Thanks for inviting me.
Now, to begin this conversation, Devang, you chose fixed income after completing your CA. Can you tell us what drew you to this field over equity?
So I was always fascinated by actually the entire thought process on deriving macros, understanding the pulse of the economy, because what I believe, so obviously equity has a very, very good orientation on research, companies, balance sheets. Fixed income, you need to more understand the pulse on the macro and understand how the growth, inflation, external sector, and all these variables are going to impact the economy. So always like the macro approach towards fixed income decision making, and that is why probably that's the more core reason for going over fixed income or choosing fixed income over equity or any other asset class. Obviously, fixed income helps over a period of time because we also do a lot of research on companies. So when I actually look across at analyzing and investing in any company, our approach is very much similar to how an equity analyst or equity fund manager would look at the company. So I am probably having the best of both the worlds, where I can have a complete analysis on macro, do my work on piece on how the outlook on economy is shaping. You can have a lot of understanding of what's happening and around the world, because you need to understand the interlinkages of Indian economy with other economies. So good understanding of macro plus the tilt towards research, both can be covered by fixed income, and hence a choice of fixed income over equity.
Devang, you started your mutual fund journey in 2006, and later you joined ICICI Pru, where you started managing the funds. And since 2006, we have seen global financial crisis, taper tantrum, credit crisis, COVID crisis. So what were the key learnings from that period which has helped you in the fund management?
So you are right. I think probably I have joined the mutual fund industry probably just in around 2006. But yes, the entire fund management and the dealing aspect for me started in 2008, because previously I was more as a research analyst, and it was in crisis. So the first important aspect what we have learned always is, like, along with the fund manager, you need to be, and the most important element for fixed income is that you manage your risks well. Because in equity, at times, as Ruchira highlighted, I think somewhere down the line, you have an exit possibility because you can sell and you can come out of a position. In fixed income, it's a 0-1 game. If you choose a company wrong, and somewhere down the line, your entire trade analysis go wrong, we have seen how in 2008, the general recovery rates has been 0 to 20%. So you lose a lot of value. And hence, from a perspective on fixed income or this entire journey, I think the most important lesson for me has been to manage risk, maintain discipline, and have that flexibility at all point of time as a fund manager. That supposedly, if something is going wrong, you need to change the positioning of the fund. So flexibility, risk management, and discipline are the learnings for me. And I would probably thank that I have been learning all throughout, and probably got that opportunity to actually enter the industry in the time of crisis.
All right. Devang, can you describe your core investment strategy for selecting different debt instruments? Like Axis Equity has a strong focus on quality at any price, extreme quality focus. So is there a similar guiding principles across your debt funds?
So we always believe in the concept of SLR, and this is the term probably we have been using since 2008. I think the first important aspect of choice of asset has always been the safety, because when a fixed income investor is looking at investment returns, he is more looking at a safe investment return. Okay, he doesn't want too much of volatility, he doesn't want any kind of trade accidents. So safety is the most important aspect. The second thing important in bond markets is always the liquidity aspect to it. And I think as a fund manager, we try and work along in the portfolios where even if we are taking some lower rated papers, we try to build in inherent liquidity structures. So the point we're trying to put across is that all point of time, what is running onto our minds is built in a portfolio which has both the characteristics, which is obviously ensuring safety at all point of time for fixed income investors, because the return expectations are always, or the investor expectations are always, that they want to invest something safe. And secondly, mention and maintain a huge liquidity into the portfolio. So these are the key principles. obviously the thrive at all point of time is also to be competitive on returns, because you will not get that investor attracted to your funds if you don't deliver good returns. So the principle is work with the safety phenomena, with the entire concept of add liquidity to the portfolio at all point of times, and be competitive of returns. So the SLR concept is something which we have been following, and in my personal capacity, I've been following since last 16, 17 years.
Devang, recently you've been promoted as the head of fixed income at Axis Mutual Fund. Earlier, Siva used to be the head of fixed income. So how long you have been working with Siva, and what were your experience working with him? And along the way, what were the learnings which have you learned from him?
So I joined Axis in 2012, and Shiva has been the head of debt from day one, from the time I've joined. Okay, from a senior fund manager, I got promoted to head of debt. Obviously, I was promoted to co-head since 2020. So I have been working along with him as a co-head for now more than 4 years. Before that, for 3 years, I was a deputy head. So I've been working as a head and a deputy head for almost now 6 to 7 years. Shiva is a great guy, and as I told you, like the certain principles which are there as a part ingrained in Axis philosophy, and I would probably say that as it couples with one. Built in the safety element of it, liquidity, and ensuring the return. The SLR concept is something which both of us have been working for last 12 years together. The another important aspect is that we believe somewhere down the line to put a lot of internal risk mandates within the fund. Okay, so I think SEBI allows us significant risk mandates that you cannot invest a particular percentage into unrated papers. You cannot invest a particular percentage into, they have rating wise grading, 10% for AAA, 8% for AA, 6% for single A. It's just started now, but they have some gradings. What we used to do is we used to come up with an internal investment policy which was significantly tighter as compared to SEBI rules, and they have been following since the time of 2009. As I think Axis was also AMC which was born in crisis, and hence the entire risk management and the risk assessment has been a core philosophy for managing of our funds. So I think that is something which I have inherited from Shiva, and that is something which we'll try and work along as we take the debt debt market ahead for us.
Devang, another thing was you co-manage around 22 debt schemes at the Axis level. How do you manage to distribute tasks and strategies across all these kind of funds?
So, how it works is fixed income is a very, very macro-oriented approach. So obviously, you need to assess the buckets. You need to assess at times, there are anomalies on the curve. There are anomalies on the asset class, which you need to try and capture. So first to explain, at Axis, we have a 10-member fixed income team. Okay. And we have 4 fund managers, 4 research analysts, 1 dealer, 1 internal risk manager. So it's a very, very big team where we have probably we have divided the tasks among each of the team members. Secondly, what we have done is, as I explained, fixed income is a very top-down approach. So you decide on the core view on rates, you decide the core view on liquidity, you decide on core view on credit. These are the 3 parameters which generally generate alpha or generate that additional return for investors. It is, again, I'll reiterate, for benefit of our investors. It is the duration, it is the liquidity, and the credit. You take a top-down approach towards what's your view on credit. You take a top-down approach on what's your view on interest rates. And thirdly, how the banking liquidity is going to pan out. If you take a top-down approach, and then what we have also done is we have a co-fund manager in all of our funds. So what does the fund manager helps me is we work cohesively in deciding the top-down strategy, that this is our core view on rate, this is our core view on liquidity, this is our core view on credit. And then the fund manager works on the allocations, depending on his view, anomalies in the asset class, somewhere the spread anomalies are there. He tries and captures that and probably generates additional return for the investors. So how do I divide my time is work a lot on the strategy, on the core thesis of how the fund is going to be run, and the other co-fund manager helps me and works along with me on internal day-to-day movements, deciding the asset allocation, deciding the point on the curve which makes sense for fixed income investors, and the entire churn on the portfolio. So that's how we divide. Second, I would say some part of my also goes in understanding companies, meeting clients, analyzing credits, and overall assessing sectors. So I would probably say 30-40% on macro, 30-40% on allocation on core strategies, one third on credit and client meetings.
So, with your recent promotion, what changes or improvements do you aim to implement, or especially in debt research or portfolio management?
So I think obviously it's been as I told you, markets have always ensured us to learn a lot. Okay, like if you look at global financial crisis, we have seen a lot of changes in regulations. We have changed in how markets have developed. We have also seen across, if you look at pickup 2000, before 2008, liquid fund didn't have any kind of limitations on majorities, buckets of papers, anything. Like you look across right now, liquid funds have actually been only invest up to 91 days. So if you see over a span of last 15, 18 years, there has been a lot of changes which have happened in regulations, the way mutual fund schemes are run, and it's a continuous learning process. So I would say it is not something that just because I'm promoted to a head, or I was 3 years back, I was promoted to co-head. There is a lot of the learning has stopped. The learning will never stop. The markets ensure a continuous learning process for investment teams, and specifically with the changing market environments, we learn every day. From a perspective on changes, I think we have already diversified a significant part of our universe. So if you look across at our universe, we look at more than 240 odd companies at Axis on the debt side. We have a significant diversified portfolio. As I told you, we have always worked across on stricter, tighter investment risk policies, which ensure us to avoid accidents. So 2018, like out of 23 accidents at Axis, we had only one. So that showcased somewhere down the line that the internal risk management was quite strong, and that is why we could probably not we could avoid a large part of those accidents or those cases. So we have built in, obviously, but it's a continuous learning process. I'm not saying that we are done with our learning, but I think we have already diversified quite a lot. We'll keep on adding sectors. We'll keep on adding new companies. We'll continue to work with the same or similar risk management philosophies and try to deliver superior risk-adjusted returns to investors. So that's, if you ask me, that's my goal. The other important aspect which I will probably want to do and use the platform is to penetrate among investors. Debt incrementally has not been, I would say, post the tax changes, the tax efficiency gone. I think investors are not too attracted towards fixed income markets. I would use this platform to probably communicate to them that fixed income as an allocation still makes a lot of sense. Fixed income mutual funds, if you choose the fund of your investment horizon or time investment horizon, and you know your risk appetite, and if you choose your fund according to that, SEBI has done a beautiful job of categorizing fund as per time horizons and risk appetite. There are PRC matrices, there are all lot of risk parameters, disclosures to the investors. If you know your investment horizon and you choose the right fund for that, I think the fixed income investor journey will be very, very good. Today, any which ways, we are very positive on macro outlook, and we would probably guide investors to add debt allocations and duration to their portfolios.
Devang, could you just step back, and you spoke that you have around 260 to 280 companies as an investment universe. So could you just help us understand how do you select particular debt paper into the scheme? Any particular way or a strategy do you use it?
See, I think investment in fixed income, as I told you, it's a 0-1 game. Okay, like my credit guy or my research analyst, the first and most important aspect which we tell them is that in mutual funds, you if you miss an upgrade of the rating, it's okay, but you cannot miss a downgrade, because the important point is at all point of times is that you should be aware of what's happening on the fixed income companies, your entire investment universe, and the research analyst jobs are probably feeding information 24/7. The most important elements what we look across at is in India, I would say probably is significant to understand is that how overall the sectors are doing, how is the financial performance of the business of the company, the operating parameters. The most important element is how the management track record has been, okay, in India, because we do a lot of work along with rating agencies, bankers, understand from various lenders. look at the track record and history of the management. Look at how much is the debt in various cycles, how the management is done, because businesses go through some kind of stress at some point of time. But how the management has handled it? Has he got the right equity? Has they ensured that business performance improves? So we do a lot of work on management track record. We do a lot of work on business performance. How good and stable and strong is the business on its own? And the third important aspect is then those financial parameters and the entire sector study. So these are the basic key inputs which we would go through at all point of time by selecting a company in our universe.
There are several categories of the debt funds available to the investors, unlike equity. So in equity, we can say, if you want to choose a scheme, you can have a flexi cap scheme or a large cap particular scheme. So is there any particular all weather kind of scheme in these debt funds which will suggest to the investors one or two kind of schemes?
So I would say, see, there are two all-weather funds. So dynamic bond fund is actually an all-weather fund for a fixed income investor. Now, dynamic bond funds are named as all seasons bond fund. Some people use gilt funds, which are also dynamically run. So it depends on the choice of the investor. But dynamic bond funds is a category which is actually an all seasons fund for investors. The second, what we have done is we have done some back testing for short term as a category. And we have always seen that for traditional investors who are looking at traditional instruments in their debt investments, but just want some 50, 70 basis or some kind of additional returns over those traditional investments, short-term category has done good over the last 15, 20 years. Again, we have back tested it for more than 15, 20 years. So I would say these are the two categories which probably investors should look at all point of time. One is dynamic and one is a short-term fund. These are the two categories which I will advise for investors. A short-term is more to a conservative investor, okay, who is, as I told you, who is looking at stability and some bit of less volatility. A dynamic bond fund is like more of capturing all cycles on interest rates, and it is pure for a debt investor who is more informed, who understands that in an interest rate cut cycle, you can see a good amount of capital appreciation because yields fall, and vice versa in a capital hiking cycle, in an interest rate hiking cycle, you can start seeing some bit of capital losses. So dynamic bond fund and short-term bond fund for the two set of investors, conservative and an informed investor. I think these are two set of categories which I'll advise.
Devang, another thing, there was a Fed meeting and they are holding the rates. So when do you see the rates, slashing down in US markets as well as in US market, as well as in the Indian markets?
So you rightly pointed out, I think if you, as against market expectation, I think the Fed commentary, specific the press conference after that, was a bit dovish. People were expecting that, probably looking at the inflation trajectory and somewhat the noise around all strong data on US, probably Powell, the governor there, might be a bit hawkish. But as against that, I think probably they were quite neutral. Our assessment is probably, if you look across at the US data, the US data is missing or is slightly higher than estimates, but it's showing a downward trend. If you look at growth, if you look at inflation to US in 2022 was in the 9 handle. In 2023 was in 6.5 handle. Today it is in 3.5 handle. So we're looking across at overall inflation trend, it is falling. The disinflation pace has fallen and it is a bumpy ride. So how I communicate to clients at this point of time is you are at the peak of the interest rate cycle, you are at the peak of the growth cycle. From here on, in the next 6 to 12 months, we actually anticipate either softening of rates or the trend for rates to be lower. The pace of rate cuts will be limited, but the trend is lower. And hence we advise clients to go long at this point of time, add debt to your allocation, add duration to your debt portfolio. Now, what kind of rate cuts we expect from Fed? I think probably 25 to 50 basis in this year. And on an overall perspective, we believe that if inflation is around 2.5, your Fed rates will be probably closer to 3.5. So over the next 12 to 24 months, we expect Fed to probably cut more than 100 basis. From a perspective of more than 150 basis. From RBI's perspective, RBI has been very measured in hiking rates. If you look across at 2022-23, where Fed was hiking in every minute policy, and somewhere down the line, the Fed hikes were significantly at times 50, 75 basis. RBI, except for the first surprise hike in May 2022, after that, RBI did 6 very, very measured hikes. slow, gradual hikes. Our assessment is in the rate cut cycle also, developed markets might be slightly more aggressive. They will cut more. Probably RBI will not be cutting rates aggressively. Today, growth outlook is also not that weak. So you have stable inflation or falling inflation, you have stable external sector and a strong growth. So I think RBI is not hurried to cut rates. RBI will be probably looking at cutting rates in second half or next year, and the amount of rate cuts we expect from RBI is close to 25 to 50 odd basis. I would say not more than 50 basis in this cycle. With that, we expect the 10-year government bond yields, which are currently trading at around 715, 720 levels, to probably move towards 675 in the next 12, 18 months. Another important point that I'll try to tell you and probably inform your clients is through in this year, we have this along with the strong macro fundamental reasons to be long debt, we also have positive demand supply dynamics, which will lead to significant positive demand for government bonds. Why this positive demand supply dynamics for government bonds? India bonds have got included in JP Morgan indices and Bloomberg emerging market indices. The put together, we are expected to see close to 25 30 billion of flows. We already got 8 to 10 billion of flows. 15 billion addition in the next 12 months will be a very, very good positive for our bond markets, and hence the direction for our bonds is lower. So strong macros, strong demand supply dynamics, a stability in external sector. I think a lot of positive factors for our bond markets, and hence the message to our clients is you should be long at this point of time and probably add debt to your allocations.
All right, now, Devang, to end this conversation, to wrap this up, you painted a positive picture for debt funds going forward. But if you had to, advise investors, how should they structure their asset allocation between fixed income and other assets in today's market scenario? What would you say to them?
Yeah, our assessment is that probably, so I try to cover this in our outlook. So if you ask me, I think probably how I look at things today is that you are at the peak of the growth cycle. And I'll tell you why I believe so. We are at the peak of the growth cycle. See, in the last 2-3 years, you have had this abundant liquidity. Like I'm sure every central bank or government didn't know how to address COVID. So after 2020, the first thing that they did is splurge money into the economy, just flush the economy with a lot of liquidity, rate cuts, and they also did massive fiscal expansion. Now, since 2021 and beginning of 2022, the things which are happening is reversal of that liquidity cycle, rate hikes, and now fiscal consolidation. The fiscal consolidation also started. You look at US also. US had gone to 10% fiscal deficit in COVID. Now they're at 6.5%, and they will directionally start. They might not be able to do everything. They start showing some bit of fiscal consolidation. Now, when you look across at Indian bond markets or Indian government, central bank, India did 10 trillion of liquidity. They have unwound that to 1 trillion of liquidity now. Rate cuts started and then they unwound it to rate hikes. Now, when you look across at the fiscal side, we had gone to 6.5-7% of of GDP. They have done fiscal deficit in COVID. Now they're at 5.1. Next year, they're talking about 4.5. So tightness of liquidity, tighter financial conditions, fiscal consolidation. All this doesn't augur well for growth. You have also started seeing RBI being proactive in managing credit, putting those risk weights on non-banking financial companies, certain sectors, trying to reduce the CD ratios. So if you look across at the entire environment, our assessment is this is not very positive for growth. And hence, we believe that being at the peak of interest rate cycle, being at the, I would say, peak of growth cycle and a stability of external sector, I think you should have a higher allocation towards debt. When it comes to, I think, commodities, specifically, I think a lot of question comes around gold, silver. We're not experts on that. But I think the rise in commodities has been more because of the geopolitical tensions. We believe this being a year of election everywhere, I think we don't envisage a hot war or a world war kind of a scenario. We believe that somewhere down the line, our assessment is at this point of time that we would not see a world war kind of a scenario, and hence commodities would probably see some bit of stability here. And probably if oil specifically, as per me, I think it is the demand outlook for oil looks very, very weak. And hence, our assessment at this point of time is that from a risk reward perspective, you should have a higher allocation towards debt. Like the last few years where you were seeing anticipating rate hikes, you were seeing tightness of liquidity and all. I think probably you should have a lower allocation towards debt. At this point of time, you should have a higher allocation towards debt. So that is how I would probably advise clients to for asset allocation.
All right, I think with that, we'll wrap up this chat for today. Hope our viewers benefit from the insights that you've shared. Thanks a ton for answering these questions.
Thank you. It was a pleasure talking to you guys. Thanks.